Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast, where we talk all things money and business. My name's Christian Allen. I'm here with my co-host, Rodney the Pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great. I realized, though, I lied.
You're not really doing well?
No, I'm doing well. I'm doing
Okay.
I'm doing great.
That's good.
But what happened is when you very first brought that up in our first episode, you called me Rodney the Pod and asked me what I thought of the nickname. And in response, I said, I think it's great. I'm going to go get a mug. I'm going to put that on there. And guess what?
You got a mug?
I never did go get the mug.
Yeah, okay. You're right. You
It's
did
gonna have
lie
to
about
happen.
that then. Okay,
Yeah,
that would be
gonna have to
good.
happen.
That's a good gift idea for me, Rod. I'm going to get you a Rod the Pod, although I'm going to have to maybe one of the sides will say Rod the Pod, the other one will go with the full Rodney.
I like
that way
it.
you can
Yeah.
go either direction.
I can
depending
flip
on
it
how
either way.
Yep.
Sweet.
Okay, Rod. Well, I'm kind of excited. Today is going to be an interesting show. And the reason I think it's going to be interesting is because we're going to take it in a few different directions, right?
Okay.
Normally, when I come into these shows, I have a very specific topic idea, like exactly where we want to go. And I still have some pretty good ideas on where we want to go. But today, we're going to throw you some of the tough questions.
Okay.
So one of the questions is coming from a listener. So we have a special request from a listener. So we appreciate them. And we're going to make sure we touch on that. But the rest of them are just questions coming from me. Okay. So the context behind those questions, Rod, is that I do a lot of reading. I try to kind of get a feel for like what people are talking about. And then, I'll go through social media. I'll kind of pick out interesting topics and questions that I think could be intriguing. And anyway, in this example, Rod, there was a couple of I don't know if they're controversial, maybe in our industry, just a touch controversial. So we'll talk about that in a second. But they're just topics that are out there that people are having, I don't know if debates, but maybe debates.
All right. Controversy,
And
debates.
the good news is, Rod, you're going to come in here and set the record straight. Like I said before, I have some opinions on this too. So we're not going to rely exclusively on you, just mostly.
So my thoughts aren't the end all be all.
They are, but I'm just letting you know that I'm going to fill in some thoughts too.
Okay.
Okay.
Sweet.
So, let's go. Let's just do it. Let's go straight into the questions. Zero context for you at all. Here's your first question on what do you think of 40-year mortgages?
40-year mortgages. Okay. Well, I mean, when you take it in the context of what we often talk about in terms of using debt to your advantage, and my opinion on this is a 15-year mortgage is less advantageous in that context than a 30-year mortgage.
Oh, interesting.
So along the same lines, if I say, well, compare the 30 to the 40, well, then because the 40-year mortgage puts me to a lower payment, I have to fork out less today, which means I have more left over that I can then go out and invest. And if I can create more return on those dollars, then the additional interest that I'm accruing by stretching out the mortgage longer, I guess I have to stick with that line of thinking.
Okay. So let's talk about this for a second. So I listened to 3 separate podcast hosts talk about this topic, and the consensus was, guess what? They do not like the 40-year
None of them
mortgage.
liked it.
None of them liked the 40-year mortgage.
Right.
So you are very much swimming against the grain on this.
Okay, and let me guess though.
Can you swim against the grain, Rod?
Against
the current.
Let's do it. Okay, yeah, or the tide or something like that.
Yeah. Okay.
Okay. So here's the way that I normally hear people have this conversation, and so I didn't see the article, but here's my guess.
Okay.
They said in a 30-year mortgage, well, maybe even you start with 15. In a 15-year mortgage, if it's a $500,000 loan, you will have paid, again, I don't know the numbers, but let's say it's $150,000 in interest by the time you pay it off or something, right?
Yeah.
And then if you compare that to the 30-year loan, it's not just twice as much interest. It's a lot more. It's like you paid twice for it, right? You paid $420,000 of
These are
interest or
good numbers,
something.
Rod. You're like on the right track. So
Okay.
I like
And
it.
then on the
Keep going.
40-year mortgage, it must be insane. Like you paid $700,000. I don't know.
You'd have to be practicing complete jackassery to go all the way out to a 40-year mortgage, Rod.
The numbers just become insane. Okay, but then, all right. So in defense of my answer, take the same dollars that you saved, or that you had of extra money, and you went out and invested it.
Yeah.
How much
Okay.
extra value did you create? Did you create more than whatever it is, the $600,000 of interest that you ended up having to pay?
Okay. So you're saying take the lower payment, go out and invest, and then you're just like, now you've got an investment account lining up next to your mortgage, and then
Yes.
it's like, if I combined those, am I better off, right?
Yeah.
And I think most people would think, if they actually went down that line of thinking, again, assuming that I'm able to generate even a slightly better return on the money than what I'm paying in interest, that logic is absolutely on point.
And just to kind of back it up even more, you would get to a place where you would have enough money to just pay off the mortgage if you wanted to. You would choose not to, but I don't know what circumstances would force you to have to pay it off. But if that happened, you would have the asset sitting there. You could use it and just pay it off and be done. So that's kind of the other, challenge that people often will have to that is you're at risk. For as long as you have that loan, you're at risk of if you, especially if you've paid a bunch of money towards it, you paid 90% of it towards it, and then you can't make that payment, they foreclose on you. You lost all of that money that you put into it. Well, again, that's only if you're out being frivolous with the money that you saved. And again, that's a legitimate concern. If you can't be smart with money, then my answer changes. But if you can take it and invest it and create more value, then that's
okay. That's interesting. And my mind went in a slightly different direction, but similar. So I decided that there is and now that you've kind of thrown this idea out there, I'm less confident than I was before coming into this. I thought that there was one right solution here.
Okay.
Turns out there's at least two. But I thought, this is really simple, Rod. So if you understand basic finance, then and again, money management in general, like there would be no reason to take putting out there and just do the same thing, right? So in other words, I take the 40-year mortgage, I have $1,000 payment instead of a $2,000 payment that I'd have on my 15-year mortgage. And if I really want to expedite my loan, then I just put the other $1,000 back towards the loan.
Yeah.
And I would then pay off the mortgage faster than I would have paid it off in a 15-year mortgage situation. So like, again, the pure math behind it just doesn't make sense. So and got to get the 15-year, because like you said, you're going to pay way more interest. But yet what they're not telling you, generally speaking, is that the reason they're giving that advice is because they don't think that you're capable of making good financial decisions on your own and being able to like put those pieces together. Okay. So that's fine. If you want to say that, Rod, I'm totally okay with that. But can I just say, what you ought to do is at least deliver the right way to do it, and then say, you know what, if you can't do this, then make sure you get the 15-year. If you're not capable of putting the other $1,000 a month toward it, then get this. But I think most people are. If they really put their foot down, they can do it. So anyway, my thought was that was the right way to do it, but I really like your idea, which is equally as right, could be even better, especially if you're a wealth building investor type. Then it makes even more sense, because obviously if I just pay down the mortgage faster, I'm saving the amount of money, the amount of interest that I'm paying on the mortgage. Whereas if I can go out and invest and get a 15 or 20% return, then I could still be getting a 10% arbitrage on the money that's there. And therefore that would be the better route. Yeah.
You almost threw out a megamindism there.
Oh man. Which one?
I almost thought you were going to say something like, how he says less right? And it was, in this case, it was like less unright.
Yes. That's right. He's like, and you, or I was, no, I'm trying to remember how he says, he goes over to Minion. He's like, Minion, you were right. I was less right. Anyway, I'm with you.
Yeah.
I was less right, Rod. I thought I'm going to give your solution, the top solution. And I'm telling you, I had time to like contrive my answer, and yet you still beat me. So good work, Rod. This is why we ask Rod the tough questions. The next question on the 40-year mortgage, then we're going to move to the next one.
Okay.
Does it make any difference whether it's an investment property or not? And the reason I'm asking this is because on the personal finance podcasts that I was checking out, they believed it did. Oh, I should give you this. So one of the hosts I was listening to was making the argument that when it's a personal residence, right, and you're getting a 40-year mortgage on a personal residence, you're generally not taking into account the actual cost of living in it and upkeep and all these other things. And so it's not as strong of an investment. Therefore, you want to pay the thing off as fast as you can. Again, I don't buy it. I don't think it makes any sense. Like the numbers don't play out that way, but that's at least where that context is. But here's what he said. He's like, an investment property is totally different. It's totally different. Now we can go to the numbers. And therefore he was pro using it in an investment property situation. And it was very much against using it on your personal residence. Any difference in your opinion? That's what I'm asking.
Well, I feel like he's backing me up on that.
Sounds like it.
Because now he's saying if it's an investment, then you do it differently. If it's your own property and maybe just the mental mechanics or like the emotional part of it that comes with it, you can't think of it the same way, but turns out.
Okay. Well, I'm with you. I think that again, the math suggests that you take the lesser payment. And again, the reason you're taking the lesser payment isn't because of the math yet, right? The reason you're doing that is because then you have less of a payment that's required of you, right?
Yeah.
Like anytime that's always a win, right? Because there's nothing that says I can't make a larger payment. But guess what? There are people and situations that come up where you won't be able to make a lesser payment.
Well, and do you know what he's also assuming for the investor?
What?
That they're going to take the extra profit monthly, the extra monthly cash flow that they have and do something smart with it. And he's assuming that the homeowner
can't.
Won't do what you're saying.
Doesn't matter if it's the
saying.
Same person.
Right.
Okay. All right, Rod. That's why we ask you the tough questions. Okay, the next question I have, Rod. Oh, I'm so excited about this one. So,
all right.
I was scrolling around yesterday. It was yesterday, I believe, on LinkedIn, and I found a question that Sarah Grillo threw out there, and she writes for Advisor Perspectives, and so I get these emails. But she's a marketing person, but focuses in the advisor community, right? So I see this post, and her post is asking the question, and this is the question I'm going to ask you next, Rod. Are fees the same as commissions? Okay, so now she's specifically talking about how advisors get paid and throwing out this question, are fees the same as commissions? And then you just have a load of people who are like, okay, I want in on this question, right? And by the time I got to it, there was like 30 or 40 responses, and and it was really interesting. So my question to you, first question around this kind of how advisors get paid is, from your perspective, are fees and commissions basically the same, and why or why not?
To me, they're not.
Okay.
And I think the biggest difference, again, there are probably many things I could touch on, but the biggest thing that I'm thinking about is the timing of when you get paid and the total of what you get paid.
Okay.
So on the commission side, usually you get paid more upfront and less later.
Yeah, I think.
And with
fair.
fees, I guess
they're more ongoing.
They're flattened. Like they're just saying, well, it's a 1% fee. Now, in that case, if I'm doing my job right, if I'm a broker and I'm increasing the value of your account, then I should get paid more as time goes on. hopefully that actually happens. But anyway, it's that 1% per year, like forever. And in that case, when you look at it over a 10 or 20 year time frame, the person who's being paid fees is going to get paid a lot more than the guy who's getting paid the commissions.
And the idea there is that supposedly there should be a greater level of service and attention, right? And that's the whole idea behind the model, is continually focusing on providing that value service.
Yeah, and you're aligning your interests, because as the client, they want their value to grow. As the advisor, they want the value to grow. They're motivated to make it grow because they earn more the higher the value goes. So theoretically, again, the idea is that you're aligning interests.
Okay. I think that's a good assessment. Do you have a preference? Like, what's better? What's better? Is there one that's better or worse, or not?
Well, part of it is we don't have a choice in some things, right?
Yeah, that's true. At some level, some things are compensate advisors one way.
Mm-hmm.
There's become more variance around that. There continues to be more variance, but there are still product services that take place that just have one or the other, and that's the way they're built.
And there are certain things. So, for example, an annuity, you can take more of the upfront commission, or you can flatten it out over a 10-year period of time or something. And I mean, initially, like early in my career, I needed the commission, right? I needed to be able to be paid more up front. But the further we've gotten in, and the kind of the more successful, the more consistent we have been at seeing business come in, we're more motivated to move to the other model, because we end up getting paid more on the fee side.
It's true
if you spread it out more.
And of course, if you thought about it, right? Like, so let's just throw this out. If I have a 10-year annuity that pays me 5% commission, regardless of whether it was all up front or some sort of trail through there, like, I'm getting paid 5%. If I put the same money in my managed account and pay 1%, then obviously I would have paid double over that 10-year time frame in one versus the other. Okay. I don't think necessarily one's better than the other, but I thought it was an interesting one. Okay. My follow-up question to this, Rod, is how important is it to work with a CFP?
Okay. I guess the answer is that it depends on what you want. If I'm looking for someone who can give me a complete overlook of all of my finances, then I think it's
reasonable.
Valid.
Like,
right. If someone says, hey, I'm only willing to work with CFPs, certified financial planners, then I could totally go with you on that.
Okay. So can I give you my opinion on this?
Yeah.
If you said to me, on a scale of 1 to 10, Christian, how important is it for you to work with a CFP professional? I would tell you that it is a certain way to go down the traditional path. So here's what happens. A CFP is proficient in all of the traditional stuff, right? So like, theoretically, they should know all the basic things about asset allocation and rebalancing and doing those core. But guess what? You are not going to play in the alternative space. So to the extent that that's what you're looking for, to your point, they are generally, there's a level of professionalism, a level of education that's been attained in that space. But here's the thing. It guarantees you almost that you'll never get into the alternative space, because that's not where they play. And it's because that's not where they get paid. Right.
Yeah.
So, anyway, that's it. Okay. But I have a further question. Oh, keep going.
Can I just, throw one more thought out there? Because the alternative to what I was thinking is, if you're not necessarily looking for someone to do everything for you.
Yeah.
You're not looking to hire that person out there, which by the nature of the type of people we work with, and it's probably exactly in line with what you were just saying, the people who are work in the alternative space, who want to invest in an alternative space, they kind of have to become do-it-yourselfers in a way.
That you have to. There's no advisors out there. There are not financial advisors that I'm aware of who are totally proficient in helping people in stock market, hedge funds. I know that's part of stock market, but like you get into like the more sophisticated hedge funds and things like that. And then you go over to the real estate side. That world has not like been conjoined, right?
Yeah.
So you almost have to become one of those people. And what we see traditionally, or we typically is what we see, people who move into the alternative space, they get into the real, they start doing a handful of things, and then they pick advisors to help them with their tax or with specific items that they're looking for focused attention to detail on.
Yep.
And then by doing that, they kind of bring it together. But I just think like if you're wanting to build wealth prolifically, like the worst thing you could do is hire a CFP, because they'll show you the perfect way to like crawl your way to a 4% withdrawal rate in retirement.
Yeah. And to your point earlier, someone might say, well, I can do the alternative on one side, and then I can have the CFP help me to the extent that I'm wanting to be involved in the traditional. But I can tell you, just from not having done it myself, but talking to a lot of people who have tried to do that, it's really difficult to find the CFP who is open-minded enough to not give you very strong opinions, very biased opinions, right? Just again, because of their education and background and the way they earn their living, against what you're doing in the alternative space. They'll tell you all the reasons why you shouldn't be investing in real estate, crypto, ATM funds, life insurance, right?
And like you said, the biggest reason typically is because that most traditional advice, and again, not every CFP is the same, right? But most of them are going to get paid primarily from AUM. The more money that they manage, the better they get paid. That ends up being the driving force. Now, again, I'm not suggesting that you can't be a good advisor and help people in these other ways, but typically what we've seen is a strong urging of the clients to go into this like more, like what ends up happening is they start to kind of talk about the extra risk that's there, and like it just kind of wears on people, and so it becomes easier to go into this like, I know what it is, I'm comfortable with it, whatever. So anyway, that's good. Okay, Rod, I want to follow up. I don't want to get too detailed in that one. My next question is, how about, okay, so I asked how important is it to work with a CFP?
Okay.
Question 2, how about a fiduciary? This is big, Rod. This is big. Okay,
yes,
you have to be a fiduciary, and if you're not, just go home. Fiduciary or nothing.
Yeah.
Okay. So maybe first, most people are going to know what a fiduciary is, but describe what a fiduciary is really quick, and then we'll talk about. I want your opinion on how important it is to work from a financial planning perspective with an advisor who is a fiduciary.
Okay, so let's define fiduciary. That is someone who, because of their licensing, certification, whatever, they are obligated to act in the best interest of the client above everything else, above themselves, above their company. The client's interests have to be number one. Okay. That's a fiduciary. Okay. So then when, like you said, there are those who say you can only ever work inside of a world where you have a fiduciary in your corner, because if you don't have a fiduciary, then the opposite is true. The person you're working with will never work in your own interest. They'll only work in the advisor's personal interest, or the company, or someone other than the client's best interest, because they're not a fiduciary.
Okay, Rod, can I just tell you, I love a fiduciary in general. Like the idea of it rings true to me. Okay. Here's my biggest problem. Maybe I have two problems. Problem 1 is that this whole fiduciary thing has become a marketing ploy more than anything else.
Yeah.
It's like, this is the edge that the fiduciaries are giving. And by the way, I've been down that road. Like when you go in the securities world, if you're Series 65 licensed, we had to be fiduciary, right?
Yep.
But we dropped all that licensing. So Rod and I are no longer fiduciaries. We are no longer honest, good.
We don't fit
any
in that
of those
category
things.
anymore.
We don't fit into this.
Yeah.
So, but here's the thing. So the two sides are, one, the marketing ploy, And what's happening is everybody who is a fiduciary is like, oh, you can't work with anybody who's not, right? And therefore, and it's scare tactics. It's that everybody who is not a fiduciary is likely out to get you. Not a fiduciary, then they are therefore a predator.
Yeah.
Right?
Yep.
Okay. I don't like that mentality. I think it's wrong. And to your point, Rod, there are many products and services that are really good, useful, and helpful that require something besides a fiduciary, right? Someone to sell that receives some sort of compensation in like a commission form, as an example.
Yep.
Okay. So that's number one. My number two thing is just that a dishonest person is dishonest no matter what, right? Like signing a form doesn't suddenly make somebody an honest person. And that idea, like, I get that there's like some value in a person feeling like the inner belief that I have to, make sure that they take care of people. And really that should be all of us. I just genuinely believe that just should be the standard no matter what. But the idea to me that signing a form or something like that to suggest that now I do it when before I didn't, and now I do, like, to me, that's too like cut and dry. That's not how people work. Therefore, it's ridiculous.
Yeah. So I have a response to that.
Okay.
Maybe a counterpoint, and then I'll counter myself. Because so the counterpoint to that is that they would say, well, a fiduciary, yes, they're taking on themselves that responsibility, and they also have oversight. So there's a responsibility in the part of
so
their
they could
managers, whatever.
They could get punished if they don't do it right.
If the oversight exposed that, the dishonesty or the, doing it in the interest of the advisor instead of the client or whatever, then there would that punishment come. Okay. So then, but now my counter to myself. So yeah, I think that's a good piece
and like
to
you
have.
could lose your license, right? So let's say that you were found doing that. Therefore, the response from oversight could be some sort of punishment or even losing your license. And so then the question is, well, do I want to play that? But here's again, I just think about it. Like if I did something, let's say that I went and, well, we've seen situations where people take advantage of other people inside the insurance business, no question, right? But I still struggle to kind of like see the difference. If I go and screw somebody over in an insurance product, like I could get just as in trouble for that.
That's exactly it. So that was the counter to my counter. Is there is oversight, right? So there are companies that, again, we don't fit under that quote unquote fiduciary thing. But when we sign a contract with an insurance company, they're creating some level of oversight, right? Or think about, you put it in an annuity application, and what's one of the biggest pieces of that annuity application?
It
is the
suitability, and they take it very seriously.
Absolutely, for a good reason.
Yeah, for good reason. No question.
And then even beyond that would be like the insurance department. Again, you could lose your license if you were dishonest out there telling people you're doing certain things and then not doing them, and the complaint goes to the insurance company. You lose your contract there. The complaint goes to the insurance department. You lose your license. So again, is there oversight? Are those things happening? Yes. The answer is yes.
Okay, Rod, because we're already half an hour into this and I have two more questions, I'm going to throw those ones out and I'm going to get to those ones at a later date. Okay. So I want to get to this question. We had a faithful listener and friend email in. He's going to remain anonymous, but he wanted to do us to do a comparison on various taxable versus non-taxable versus, well, you're going to go ahead and show us this. So I'm going to turn it over to you, Rod, and you lay out the premise first.
Sure.
And then show us your results from it.
Okay. So specifically what he was asking for is, he says, all else being equal, the ROI on a certain amount invested in just straight cash. I guess invested is a loose term there, because in this case, he's just saying you take the money, you put it in your savings account or checking account, it just sits there, right?
Yep.
Versus 100,000 invested in a traditional IRA, 401k qualified account, versus 100K, or again, this X amount that was taxed and then put into a Roth. So those are the 3 he asked for.
Okay.
I added 2 more.
Good call.
Okay. So on the one, and we'll show you here in a minute, but on the cash one, I thought, okay, well, there's an alternative to that, right? So are there people who take large amounts of money and do set them in the bank account for different reasons? Could be emergency fund, could be, business reserves or whatever. It needs to be liquid, needs to be available. That's why it's sitting there, but they leave it sitting there for long periods of time. So are there people who do that? Yes. But that's usually like one piece. That's the liquid piece to their overall financial picture. They have a lot of other money that's out invested in other places. So to go beyond, again, what specifically he was asking for, I also added, if you took that same amount of money and put it into an after-tax brokerage account where you're earning X amount, again, we'll keep the return that you're getting inside of these investments equal across those 3, the IRA versus Roth versus after tax. And then I couldn't help myself. I had to add a 5th one and say, well, what does the Capital Avalanche do with the same amount of money? Okay. Again, I couldn't help myself.
I'm excited about this. Okay. So you're going to actually show your screen though. So anybody that's listening, if you have the ability to check out YouTube, then we'll actually throw these numbers up. Rod's put them together so they're nice and organized and easy to view. Sweet. Okay. What do we got here?
So I threw this together this morning. Scenario 1 is our 401k IRA.
Okay.
And our constant across all of these scenarios is, I'm going to say, what if you put $100,000 a year away for the next 10 years inside of each of these different buckets?
Okay.
And then my other constant, 2 other constants. Number 1, the tax rate is 25%.
Okay.
Across
100,000 in, 25% tax rate, and
and just to clarify, 25% tax rate now while I'm working, and then the same tax rate in retirement.
Okay.
I just, again, to keep it constant. And then the rate of return in all of these, the first 3 is a 10% return on the money that's invested. Again, we're just assuming it's traditional investments in the stock market, average of 10%. Check out some of our other podcasts to learn how we feel about average versus actual. So in this case, it's an actual return of 10%. So in the market, you actually might have to get 12% or 13%.
That's an interesting point, Rod. I hadn't thought about that.
To get the 10% actual. And we'll see where that kind of comes in later with
okay, so we're really giving these like some strong inputs, right?
Yeah,
I wanted to do that. Linear 10% every year.
Yeah, I wanted to do that for a few reasons. Number 1, I didn't want anyone to come back and say, Rod, you're short selling this. The market will does better than what you're saying. I'm actually, even at 10%, that's better than what historically over long periods of time it does. And then especially when you compare average versus actual.
Yeah. Okay. I like it. So this is probably closer to a 12% average return. I like that. Okay, good.
Okay. So now on scenario 1, 401k, the money goes in, it's growing over time. And then, and again, sorry, I want to take another step back. We're assuming a 46-year-old is starting this, who then puts it aside for the next 10 years and then retires at age 60 is when they start taking the income.
Okay.
Taking income from age 60 to age 90. So for 31 years. So in this case, when they get to the point where they're ready to retire, they have $2.3 million sitting in that IRA account.
Okay.
They go to their broker. The broker says, well, you used to have the 4% rule, but now it's 3%. We're going to take 3% off of this, which turns out to be I just used a round number of $70,000. Okay.
Okay.
But that's money that hasn't yet been taxed. It was pre-tax when they put it in. It grew. Now when they're taking it out, taxes due is $17,500 because again, we're still at the 25% rate. So net income coming out of it is $52,500.
Okay.
Okay.
Got it.
Play that out over time. They take all that income out to age 90. They took out a total of 1.6 million. And again, because of that's the silliness of having a 10% return with taking the 3%, because the balance becomes massive.
Yep.
The balance became 30.7 million to the heirs, which then they had to pay tax again. We'll just assume they were in a 25% tax bracket as well. So the net dollars that actually go to the next generation is 23 million and some change. Okay.
Excellent.
Let's look at the Roth.
Okay.
So this is scenario 2 on the Roth. We put the 100,000 aside.
Hold on really quick, Rod.
Yeah.
Really quick. Just for clarity, the first examples are traditional. Roth just means that we're going to pay the tax first.
Yep.
We're paying the tax later on the first example. We're paying the tax now on the Roth scenario. Okay,
correct.
Keep going.
Yep. And then everything you take out is going to be tax-free. So you're setting aside the same 100,000, but you have to pay tax on it. So you pay 25,000. So 75,000 a year for the 10 years is actually what ends up going into the investment.
Gosh, where that has to 10%. Be that has to be way less money at the end. If you don't have that 25,000 already, that has to be less money, right? You're investing 75% of the money.
Yeah. It's
okay.
True.
Well, I'm excited. Tell me what you came up with, Rod.
Okay. Well, here's what's interesting, Christian. In the year before you start taking the income, so the end, last day before you turn 60, you start taking the income. You have $1,750,000 in your balance, and remember, you had about 2.3 million in the.
Okay. So I was right, Rod. You're way ahead.
But the 2.3 had not yet been taxed.
Oh shoot!
So we took 70,000 of income to get 52,500 of net after we had paid tax. That's the net amount that we had that was spendable. Well, guess what? 3% of $1,750,000 is.
I'm gonna guess 52,500.
You nailed it. You nailed it. So it's the exact same income. It's tax free this time. You don't have to pay the tax, but to your point, on the lower balance. So same number. Okay. So when we fast forward, your total income having come out is that $1.6 million number. You have 23 million sitting in the balance, which again is a lot smaller than what you had, but you don't have to pay any tax on it. It's just all passing on to your next generation.
Okay, Rod, I'm coming up with like an observation here.
Okay.
And tell me if I'm crazy on this, but it appears to me that scenario 1 and scenario 2, with all things being equal, are exactly the same.
And you are correct.
Okay, good. This is a funny thing though, because I remember like when I was I had already been in the business for like 4 or 5 years, right? And I'm in this training meeting with my manager, right? This is still 15 years ago. And in the moment where like they're having this conversation and he's like, I wonder which one works out to be more. Like we like genuinely didn't know in the moment. He like goes through and he's like doing the math and he's like, huh, it's the same.
Yeah.
Anyway, it's just a funny thing because we always think it's going to be the only thing that makes these scenarios different is obviously different if we differentiate tax rates and we differentiate rate of returns.
Yes.
If that doesn't happen, rates of return. If that doesn't happen, then all things are going to end up being exactly equal.
Yeah. And it's almost even knowing that that's what the expectation is. But when you're actually running the numbers and you're like, I wonder how it's going to come out this time. And you calculate it and it's like, it is the same number.
Okay, Rod. So now that we know that scenario 1 and scenario 2 come out to be exactly the same, let's move into scenario 3.
Sweet. Okay. So for scenario 3, what we did is we took the same 100,000 a year going in for the 10 years. In this case, we were paying the tax and putting it into an after-tax investment.
Okay.
Think of it like people who have money, they just funnel into a brokerage account or something like that. Right.
And we're still using the same 10% rate of return.
Yes. Yep. And then the same
linear
25%.
Every year rate of return.
Yeah.
Okay.
Now, the one thing that's different on the tax is obviously it's an after-tax account. We're getting taxed on this as the growth happens. And we get a lot of people are frustrated with this. Like in the brokerage account, you might say, well, I didn't take the money out. Yes, but your broker was buying and selling mutual funds. Inside of the mutual fund, they were buying and selling stocks. So you actually still get some taxes along the way, even if
That
you
is an
didn't.
important point. And of course, if you held it everything exactly as is, then it wouldn't be taxable because it's taxed like it's capital gains, right?
Right. Yep.
Okay. So that is important. So
Yeah.
more than likely, there's at least in your after-tax investment account, there's at least some tax that's being paid year to year.
Yep. And we are applying a capital gains tax to that portion of it as you're earning it and as you do it. Okay. So then later, what's interesting is when we get to the place where we're getting ready to start taking the income, the balance is a 1.7 million. So it's a little bit less. Remember in the Roth example, it was $1,750,000. Now we're $1,706,000.
Okay.
Okay.
So the tax had a little bit of a drag on it.
Yep. But I wanted to keep things equal. Let's take the 52.5 of income again, because we're ending up in this unrealistic example, building this massive balance moving forward. And by the way,
Rod, why did you decide? You probably told me this already. You probably told the listeners this, but why did you decide to go with the 10% return and a 3% withdrawal rate?
Oh yeah, good question. Okay, so the 10%, I didn't want anybody coming back and saying, "Oh man, you just were, being so hard on this other side while being, generous
shortchanging."
Yeah.
You don't want to shortchange the ability for a basic mutual fund portfolio to produce a decent return.
Yeah.
So we gave it what I think anybody would think is a solid return, especially when you consider that it's linear.
Yes.
Okay. And then what about the withdrawal side?
Yeah, I'm glad you asked that, because basically what I was doing is I was saying, well, this is the conversation that the broker is having with you. When you get to that point, you're age 60, you're saying, hey, I'm going to start living off of this, turning my nest egg into a stream of income. Okay. And they would say, okay, well, what's a safe amount that we can take? And that's where they would come back and say 3% or somewhere thereabouts.
Yeah, somewhere in that range. Okay, I think that's fair. So you're just trying to build it out in what is like happening out there, realistic view, practical application.
Yep, exactly.
Okay, excellent. But obviously, when you're earning a great return like this, the funny thing is we talk about the 4% rule and how it's all broken. Mm-hmm. In this situation, it's very much not broken, because if you are every year getting a 10% return and only spending 3%, you're going to do pretty well.
Yeah, you probably wouldn't only ever take 3%, right? Let's be honest. You'd take more. And technically speaking, even in that model, they would say start taking income but then take increasing income to compensate for inflation and other things like that. So, but again, I wanted to not get too complicated with the example, keep it relatively simple.
Okay, I like it. So now we get to the results of the tax investment account.
We take the 52.5. So again, that number is going to end up the same. It's the 1.6 million total income coming out, because I normalized that income for the 31 years. And then in the end, the balance that goes to your heirs, which again, you've been paying the tax as you go. There's probably some unrealized tax gains that would go to your heirs. But for all intents and purposes, I kind of was treating it like you've already just been paying the tax as you went. So it's $22,495 that goes to, $22,495,000 that goes to your heirs. So that's interesting. When you compare that to the Roth option, the Roth should be better, right? Because you get the tax advantages, and it is in this example, this kind of apples to apples, 23 million and some change coming from the Roth, 22.5 basically coming from the after tax.
Interesting. It's closer than I would have anticipated.
Yeah, me too. I was surprised by that too.
Cool.
Okay.
Now we're going to number 4, Rod.
Yeah, moving to
where
scenario
it gets really intriguing.
4.
When we go to the cash option.
This is the one where I think just to have, I think, see the reality of opportunity missed if you're setting money aside and not doing something with it.
Okay, Rod. Okay, before we get into this, I have to say this. So I was looking at our Money Insights, just cash accounts, right?
Uh-huh.
And you do a good job of making sure that our cash is in, like, try to get it in like money markets and stuff. And I was looking at it and I was just thinking to myself, like, opportunity cost really is all over. Like, sometimes I get lazy about moving money into the right places, because if you have high balances that are like continually there. It just becomes like normal, right? But anyway, here's my point. This kind of scenario, like the difference between if they would have even put this in like a money market account.
Yeah.
Like, anyway, it's just interesting. So I think it does a nice job of articulating or making it really clear that you can't just save.
Yeah.
Okay,
the reality of it. So in this case, again, it's the same 100,000 a year going on in for the 10 years. We pay tax as we go. So we have 75,000 a year going into just a checking account or under the mattress or the safe or whatever. So a total of 750,000 goes in. It's not earning anything. So it's 750,000 when it comes time
shocker,
to start income.
Okay, so that is a big difference between. Now, it's obviously really funny too, because like it's not invested, and then we're also going into the income phase. Like, hopefully no one would do anything like this. Like, I just really hope that this is not the plan. But can I just tell you, it's not shocking to see that kind of thing.
The result,
right?
So because now, before we start taking the income, our balance is the 750, right, as expected. We can't take 52.5 for very long in that scenario. So I said, okay, well, what would it be over the 31 years? How much could I take to basically just drive the account to zero? So 24,194 per year is what I'm taking out of that. No tax due because there were no gains. And
this one's really exciting, Rod. Let's move off of scenario 4.
Okay.
We've now talked about
the
good. Roth. Oh no, we talked about the 401k IRA example. We went into the Roth IRA. We went into the after-tax one, which changed a little bit from the previous two. Now we've done cash, but now we had to really, like, we didn't have a choice. We had to show option 5, which is
using the capital Avalanche. So, and again, the listener didn't ask for this, but here we go.
Can I just say something, Rod? This illustration that you're about to show, it really does show why this concept strategy is far and away the most effective income producing strategy that like exists out there. I haven't seen anything that even comes close. Okay, keep going.
Okay, so 100,000 a year goes in. We are putting that towards the capital Avalanche stacking policies as we go. And
which means we're using leverage each time. Okay, Rod, so we've been through the first 4 options. We have one option left to go. First one is our 401k IRA option or comparison. Second one is the Roth comparison. Third is the after-tax investment account, brokerage account style. And then we have the tax example. And finally, Rod, the one we just had to do, it was the capital Avalanche. And I'm excited to see what you came up with.
Yes. Okay. So in this case, you have the 100,000 a year going of income that gets taxed. We pay the 25,000 in tax each year. So we have 75,000 remaining that goes into the plan per year for the 10 years. Stacking the policies to build it up, but get the most leverage possible. And when we play this out, we fast forward by age 90, we will have taken a total income of 20 million.
20 million. Okay. So how does that compare with the first ones, Rod?
Well,
pretty similar in income, right?
Well, what's funny on the income is that you're forced to take less income in like that 3% rule, 4%, whatever rule in an account where you can lose value is just forces you to not take very much, not dare take very much. Right.
Yeah, that's the issue, right? Because obviously if you have those off years, then it kind of throws things out of whack. Yeah. But to be fair, again, if you were getting a 10% linear return for a few years in a row, you'd probably feel pretty safe increasing that rate. But here's the deal. At the end of the day, it's still about the total value.
Correct.
And so we're going to hit on both the money that I can take as income and the money that I would have as an estate planning play for my heirs.
Right. Because in addition to the 20 million of income, there's an additional 18 million plus 18.3 million of death benefit that would then go to your heirs. So all told, when you combine all of them, all of them are pretty impressive, right? When you just think about, again, we talk about this compound interest and kind of all these different principles. Now you add the leverage, especially, that's really what sets this one apart.
Okay, so Rod, if I was able to predictably guarantee somebody a 10% linear return, I would have people lining up around my block to
Yes, you would
invest, right?
Yep.
So that part is, but here's the thing. Even with an impressive performance, like a 10% linear return, the Capital Avalanche is basically double the amount of total capital that it's producing. It's an avalanche of capital. We have not just the $20 million of income, but another 18 million and some change in death benefit. So it's important. Now, there is one major difference that I want to make sure that you hit on this, but I don't want to pretend that there is not at least some additional level of risk that takes place. Now, I say that, and I'm not sure how much how much more risk there is, because obviously we have a lot of things that we're doing inside the Capital Avalanche to mitigate risks. It's also using an IUL, so we can't lose money in a given year like I can in those other accounts. So it's kind of a weird dynamic in my head. Like, obviously, when there's more leverage, that does increase risk. It has to in some way. And yet we don't have the market risk that is associated with the other accounts. So in some ways, they're probably similar, particularly when you take into account that we're not using outside collateral on the premium finance design. So everything's super conservative and self-contained.
Yeah, when
anyway,
you think about it, what's interesting is the actual asset, the underlying asset, these life insurance policies are producing about a 5% net return, right? That's the actual return that the asset is doing. So then it's the leverage and the tax-free nature of it that gets you to these massive numbers when you compound it over the 44 years between when you started and when you died.
Okay, Rod, this was fun. I think this was a good one. I'm hoping to our anonymous listener who was kind enough to send us in this question that this is helpful. You know who you are. Email us and let us know if we hit the nail on the head or if we just missed it completely. Does that sound good, Rod?
That is a deal.
Okay. Rodney, thanks for putting this together. This was great. Thanks, everybody, for listening to the Money Insights podcast this week, and we hope to see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.